What's up, everyone, and welcome to another episode of Let's Talk About Real Estate. And today I got my man David Starleper here today from First Home Mortgage. Welcome.
How you doing, man? It's good to be
Brought
here.
us
Thank you.
Nice little bottle of tequila here.
Yeah, have to give a little shout out here to my cousin Patrick Starleper and my good buddy Zach Esser with Starleper Insurance. So homeowners insurance and mortgages, we got you covered.
They gave you the bottle there.
Yeah,
huh?
thank you,
well,
boys.
Cheers to them.
Appreciate you guys.
Gentlemen, cheers everybody.
Tell me what you're thinking with this.
I'm going to give it a solid 9.
That was a prediction before
9.
you even tasted it.
I tasted some beforehand.
You smelt it and you were like, all right, that's a 9.
Some people have a gift.
Did you ring the bell? He did tell me
we
about
did.
that.
We rang it. We'll ring it when we're done, too.
All right, let's do it, man.
So let's dive in. So what's going on in the market? Everyone thinks it's all doom and gloom. The market's going to crash.
Yeah, so that's a loaded question, obviously. I think before we can talk about where we are or where we're headed, let's talk about where we were before. So previously, right, a year ago, you could buy a house 2 or 3% interest rates. Everybody kept saying there wasn't enough inventory.
Right.
There was never going to be enough inventory. Why? Because demand was through the roof, right? Demand was so high that historically we've never seen interest rates that low before.
No.
So when I hear people say there wasn't enough inventory, of course there wasn't, because you had way too much demand, right? You have a ton of demand, not enough supply, cost of goods goes up. Right. So I think we, as human beings, right, we get greedy and we kind of have tunnel vision. And the main factor is, right, you could buy a $500,000 house, but you had to pay what? $550,000.
Oh, yeah.
$560,000.
$600,000.
Right. Appraisal gaps, paying for their transfer charges. So you had to come out of pocket, for a ton of money, right? But you got an interest rate 2 or 3%, which is incredible.
We have people giving boats,
right?
Cars, offering them with the offers.
Man, you got to just keep putting it in there in the terms, right?
Yeah. Second child,
right?
No big deal.
Newborn, right?
All of them.
If it was depending upon how much it was crying, but you could buy a $500,000 house, you had to pay $560,000 for it, right? Which was fine because you had an interest rate of 2 or 3%. So due time, it was going to offset. Where we're currently at, though, the market's completely shifted.
Yeah.
Right. And most people, right, you're first-time home buyers, you're living in a house for 5-7 years. Right. So when you look at an amortization schedule, and I'm going to give a couple different scenarios here, but let's say you bought that $500,000 house, but you paid $560,000, $575,000, right? Your interest rate's 2 or 3%. You just know that longevity and long term, right? Eventually, me overpaying will be offset by that lower rate because you got 100%. More money going to principal than you do to interest. With that lower interest rate. So it's fine, but you better be in that house for a while to mitigate your risk, right? Yeah. Now everybody's like, fear God, I'm not buying. Interest rates are through the roof, and they're kind of looking at one component. They're not looking at big picture.
Right.
What is the market offering? And that's really where you and I come in, right? The big factor now is you got to have a mortgage professional, a mortgage advisor. Yeah. You got to have your real estate agent that is creative to use different components to actually make the market beneficial for you to buy.
Right.
Because we all know timing is never going to be perfect. It's never going to be exactly what you want, but how do we take those key components to make it beneficial? Yeah. Right. On the news, what are you hearing?
Oh, everything doom and gloom. Yeah. I mean, if it bleeds, it reads. So I mean, the worst thing you can put out there is what everyone's watching.
Exactly.
No one's looking at the good stuff.
They're all saying rates are 6 or 7%. Don't buy. You got to wait.
Right.
People ask me all the time. But where I look at this, if I'm a buyer, I'm actually buying in this market. Why am I buying it? Because I now have all the cards. I have the chips. I get to make the decisions. Right. And it shifted from a seller's market to a buyer's market. Why? Because of demand, right? Demand's not as high. Yeah. So there's more supply that's out there.
A lot more.
And it's now transitioning. In that same example, right, of the $500,000 house. So you could buy that $500,000 house before $560,000, $575,000, like I was saying, right? Or you can buy it now for $500,000, right?
Or $490,000 or $480,000.
Exactly, and we have a lot of those right now together, right? Where they're coming in undervalued, or better yet, we're getting seller help, right?
Lots of it.
So they're now taking this $500,000 house. We're getting it for $500,000 or lower. The rate's 6 or 7%. Which, what does that mean for your payment? Your payment's maybe $500 higher. But how are we mitigating the risk? We're mitigating the risk because we're getting seller help.
Sure.
So now you're coming out of pocket you're coming out of pocket with less funds for the house. And now, Josh, we're holding on to, an extra 15, 20 grand.
Yeah.
So you do the numbers. If the difference in my payments, $500 a year, that's what, $6,000. We get 15, 20 grand. That's going to cover you, 3-4 years.
Yep.
Right. So if they cover us for 3-4 years, we know that. We don't know, but most likely things are pointing to, and we're going to talk a little bit about what the Fed's doing in the market, but we are now seeing that, okay, most likely the market's going to come back. So you're telling me two scenarios, right? I either buy before, way overpay, right, which is fine long term for where we're at, or I buy now closer to what the house is worth, right, and then I'm able to get in with less funds out of pocket. That extra 15, 20 grand can help you make the higher payment on the $500 for 3-4 years. You're okay. You're set up for when we can refinance.
Yeah.
I
mean, there's still people bidding on houses. We had one where the buyer went 50 grand over the asking price. Our buyer wasn't willing to do that right now, but there's still people willing to do it.
Yeah. And really that's the key, right? Because I get a lot of people that come from different lenders and they're like, wow, we haven't heard these creative solutions or we haven't got the big picture of the market and where are we heading. And that's our job is to educate, to explain the whys. So in those two different examples, I'm ready to buy now. You look at that amortization schedule, let's just say at 560 or 575 with an interest rate of 2 or 3%.
Right.
Or you look at an amortization schedule of now 500,000. We got in, let's just say 7% interest rate. Difference of the payment is $500. But you look at the amortization schedule in 7 years. I'm going to come back to why 7 years. And in that 7 years, right, you're actually ahead equity-wise from buying a 500 with the higher rate.
Right, for sure.
Right.
Yeah, because you're not paying $565 or $100,000 over the asking price.
Yeah.
I mean, the rates, they may come down. More than likely they will at some point in time over the coming years. It's a matter of one refinance then.
Exactly. And then I say 7 years because history shows us. We always have to go off of what are the facts?
Yeah.
What does history show us? And history shows us that markets come back every cycle about 7 years where they go through a full cycle.
Right.
So that's why I use 7 years in that amortization period because that's the determining factor based off of everything we've seen from a historic standpoint.
Right.
So that's a big factor there. So and really that's the key that I'm trying to stress to clients right now, and what makes myself different is that it's more the personalized planning, right?
Yep.
But understand what's your time frame. What are your future goals? I love it when I speak with a client and they've already spoken with another lender, and the other lender just got their info and they said, "Here's your payment. Here's your cash to close. Right, you're pre-approved."
Right.
And they're left like figuring it out for themselves.
Or it's not right.
Right. And that's not how it should be. It should be, I'm understanding all of those components. I'm taking a niche program that I have, which at First Home Mortgage, we're the number one purchase lender in the state of Maryland.
Sure.
And have been for over 10 years. And the main reason for that, specifically with myself, is doing that personalized planning. And all the other loan officers are doing those same things. But I'm providing to them these options.
Extra value.
The extra value, and also just explain the why. In school, I think that's a problem with our society.
They don't teach business development or how to talk to people, how to deal with people, what's motivating them, not motivating them.
It's funny. It's like, in high school, I'm learning in art how to stipple.
Right.
What am I going to use that for?
Right.
But learning about credit or learning about different
Closing
facets. Gift. Exactly. Of
how
to make those things
sweater.
work. Yep. Yeah, exactly. The cooking comes in handy though, right?
It does. It does. So what programs are you getting creative with? Like, what's an example?
Yeah. So once I understand that time frame, those future goals, and I'm giving them something that's tailored to their situation, right? Which it's funny because I use the perfect example is when it's your wedding day, right? It's your wedding day. You're not going to Macy's and getting a generic suit. You're getting something that's tailored because it's a special day.
Sure.
Same thing with buying a house. So we should be able to understand those things, then take niche programs, which we'll dive into, to then be able to give you something tailored to set you up for financial success down the road.
Right.
And understand you want to own investment properties, vacation home. You don't want to be looking back in 5 years and going, man, I wish I would have known this stuff then. Let's prepare for it now.
Yep.
So really that's the big factor, for myself. Loan program wise, right? So a few things. You're hearing about ARMs. You're hearing about 2-to-1 buy downs. We're using those 2-to-1 buy downs, but realistically,
so give an idea. What's a 2-1 buy down?
Yeah, it's a 2-to-1 buy down. Let's say we can get seller help, right? So let's say we can get 15, 20 grand seller help on a $500,000 house, right? We can get that 15, 20 grand put into a separate escrow, right? That goes into a separate escrow to then buy the rate down by 2%.
Okay.
So let's say the rate's 7% right now, right? We can get the seller help. Why? Because the buyers have the leverage right now.
Yeah.
And we go down and now you buy down 2%. That's 5% for the first year. And then you have 6% for the second year. And then that's basically in hopes that by then we'll be able to refinance. And that's all paid by the seller. Can't be paid by the buyer. But that's how we would use those special programs to make it more affordable in those first couple of years.
What's an ARM for someone that doesn't know?
Yeah. So adjustable interest rate. So there's different ARMs. For example, a 5-1 ARM. The 5-1 ARM is going to be locked for 5 years, and it's going to adjust for every year after.
Sure.
I'm not necessarily really looking into those right now. Reason being is opportunity cost, which is another thing I want to talk about. But the opportunity cost of the 5-1 ARM that's here, the difference in the rate's very minimal for this potential risk. What if the market doesn't come back in 5 years? It's not necessarily worth it. And I think it's going to become, more prevalent in our market if rates continue to rise, which we'll talk about. I know that's the elephant in the room.
Yeah, right.
Where's the market going? But I don't find that it's worth the risk. I did just use one for a veteran. Specific example is, he's only going to be stationed here for 4 or 5 years.
Okay.
So it makes sense to be able to use it, right? So we'll take advantage of that little bit of a lower rate because we already know we have his paperwork for where he's headed in the future. But really, I'm still kind of staying away from the ARMs right now, predominantly.
Got it. All right.
Yeah.
So what else is getting creative? What's the next step for someone?
Yeah, so the creativity, right? You talk about loan programs. You talk about the 2-to-1 buy downs. The other loan programs I like to talk about right now are renovation loans.
Okay.
Right? Because now we can buy a house, let's say a $500,000 house. It's not the one that you want, but it's tough to find new construction right now because the builders are eating up a lot of the property, or there is
Can't
none.
get materials.
We can't get them.
One or the other.
Right? Which is going to lead me into the crisis, talk about 2008, the comparison. But, you're being able to use a renovation loan right now of where maybe the house isn't everything that you want, but we can put in, $100,000 worth of work, give you what you want with the potential upside of refinancing down the road. And then we kill 2 birds with 1 stone. We financed all the renovations. Then the market has done it naturally. It's dropped down to get that lower payment then.
Okay.
So it just all depends upon the client's situation, and it's taking that time to understand that. I'm a big story guy, as you can tell.
Yeah.
But the story, I had an older client, and this is when last year market was crazy through the roof. The phone was ringing off the hook, and I was with different lenders out at happy hours, whatever it is. They ask me what I'm doing, and I talk to them. I'm like, yeah, I do 45 minute to an hour consultations. Why are you doing that? Like, wouldn't you just 15 minutes be on to the next one? No. And my favorite example is I had this older lady. She was about 80 some years old. So last time she bought a house, I'm pretty sure.
Quite a bit.
Yeah. She walked into the bank and they said, are you going to pay this loan back? And she said yes, and then walked out. It's not like how it is today.
Yeah.
So it was all new for her. So I was helping her get her bank statements, helping her get all of those things. And my buddies are like, man, you put all that time into it. It was only a $200,000 deal, but it's not about the deal. It's about the people. Exactly. Right. And after I had done that, her son was buying a custom $2 million house, forced him to come over and use me, left the other lender. Yeah. Their cousin was buying a $500,000 house, and it's never about the number, but when you take care of people,
they take care of you.
Exactly. So I love those stories because they're first examples of it. So we have different loan programs, the creativity that's coming into play. This current market of where we're at is we're seeing that shift with buyers, right? I don't know if you want to dive into the market or...
Yeah, I mean, that, or let's go... If someone were to buy a house right now, I mean, a lot of people don't even think they can buy a house. I mean, you have one right now where they just went under contract yesterday from one of our agents. They were going to rent. Yeah. And I said, why the hell would you want to rent right now? The rent's significantly higher than the prices are percentage-wise, and they're just going to keep going up year over year. How much equity are you getting out of that? Zero. You still got to deal with all the bullshit. And what if your tenant wants you, your landlord wants you out all of a sudden? Then what?
Exactly.
Or they want to jack your rent up even more because there's nothing available.
And shout out to Chanel for that one. Yep. So excited for our first one together. But perfect example. And that's a lot of clients right now is that they don't think that they can buy. They're like, I don't have any savings. I kind of feel like I'm stuck. But they don't realize that there's all these special programs out there, especially for first-time home buyers that offer down payment assistance. We just got that specific example, let's go over that one, right? So payment was roughly around $1,700,
Sure.
somewhere in that range.
Yep.
I don't know exactly off the top of my head,
Right.
but cost of rent one of those homes is going to be $2,000, $2,100.
Right.
Right. Also, why is that? Why is rent going up? Rent's going up because property values are going up.
Right.
Tax assessed values are going up.
Yeah.
So their property taxes are going up. Landlords are able to then charge more
Right.
because of all of those, the factors that are changing. Where now it's they're paying less to obtain equity, and that's the first step in building financial wealth.
Yep.
And generational wealth, I should really say.
Yep.
So most people, you ask how much can you get to get into the home, right? And I always tell people that you need $2,000, right? We've done it for less, but $2,000 is a nice cushion because it's $1,000 for earnest money deposit, right? $500 for home inspections, and then I give an extra cushion for home inspections as well, $500 to $1,000, because if it's on well and septic, you're going to need those upfront costs. Have I gotten people in the house with zero money? I have, right? Home inspections, we used one that was just previously done.
Yeah.
The earnest money deposit, we actually got back from seller help.
Sure.
And then down payment was all covered through the state of Maryland with
Right.
special programs that we have there and in-house products that we carry.
Sure.
So you have $2,000. If you have less, we can still make it work.
Right. They want people to own homes.
Exactly.
I mean, they're making more money that way.
Yep. And that was one of Governor Hogan's things when he came out with the Maryland Mortgage Program and this down payment assistance. It's how do we make it more obtainable for people to purchase homes, right? Because when they look at statistics, they're like, the millennials, we're way behind.
Well, they think they need 20% down and they need to have good at credit and all these things, and it's just not the case. It's far from.
It's the misconceptions that are out there for sure. So, having those down payment assistance programs to cover down payment, getting seller help, especially in a market like this, is the key to getting into a house with minimal cash out of pocket. And you talk about renting, you're going to need a security deposit. So if you're renting for $2,000, you need $2,000 up front for the first month. That's the same to buy a house.
Well, you need $2,000, then you got the security deposit, then you may need a last month's rent depending on your credit. So what you're $6,000 deep. You could definitely buy a house.
So it is, to everyone out there, it is obtainable and it is right in front of you to be able to buy a house.
Yeah.
So
just need to ask. You need to talk to somebody.
And you just got to get educated.
Right. What's the worst? I call you, my credit shit. I don't know what the hell I'm doing. I don't think I could buy a house. We have a conversation. I get a soft pull on my credit that disappears, and I now have education on what I should be doing, what I should pay down.
And what I call it is an action plan, right? We're going to do it. We are going to give you an action plan on what you need to do to buy. And there's so many intricacies to credit that people are like, I don't have good credit. And I just had one, this past week, credit scores were 580.
Yeah.
I said, make this small adjustment to their credit card. It was very minimal. And now we got their credit scores 660. They're ready to buy. And it's been 2 weeks.
Right.
So we got that many points in the short run like that.
But they don't, we most consumers don't understand what to pay first. They think, I got this $18,000 credit card. I got school debt. I got this. Oh, I should definitely pay my school debt down first. And they try to take, the biggest chunk out of it they can, and they get nowhere instead of paying the small thing off or paying off the car or paying off whatever else.
It's how do you use your funds to the most cost-efficient manner to be able to make it work. And that's part of the education. And that's part of what makes, myself different is I want to provide that education. When I first came out of college, I had a job that was in commercial real estate with software and analytics, right? But I soon realized that job was based off of longevity or how long I was with the company. It wasn't based off productivity.
Right.
And I wanted a job that was based off of productivity.
Not with a ceiling.
And not with a ceiling. And I also wanted a job where I get to talk to people. I enjoy hearing people's stories and then being able to take them, right, and their goal is to buy a house and being a vehicle. I say, I'm going to be a vehicle to help you there. You're going to be a vehicle to help them get there. And then you're being that vehicle to get them there. You get a certain affirmation from it at the end of the day.
Yeah.
So those are the exciting parts of being in the industry. But I call it the bipolar industry, man.
It's everything. I mean, there was, through June, 1.6 million agents in the United States. Less than 1.3 have sold 3 houses or more.
It's the highest highs. It's the lowest lows.
Right.
And there's some days, I'm sure you feel like this on a regular basis, but like yesterday, I was leaving the office late, 10 o'clock at night, and, you feel like a zombie coming out of there.
Right.
Right? But what you're doing is making an impact. And that's the motivating
factor. It's the name of the game.
Yeah.
Phone always rings.
Exactly. So talk to me a little bit about, some strategies, I obviously know, but for everyone else, that doesn't know on a regular basis, like strategies you guys are using from a marketing standpoint to be able to get these people and to get our clients into homes, either for a lesser value or getting seller help. Like, what are things that you're doing?
I mean, most agents aren't equipped for this market. All the ones that got in the last 2 years, a third of them will be out within the next 6 months. Yeah. So you're talking hundreds of thousands of people that are just going to throw their arms up and say, I got to go back to a 9 to 5, or they're not even doing a 9 to 5 now. So they're going back to working more hours for less pay and less structure. Well, more structure, I guess, for them because they don't know how to structure their day. But even with all our agents, we're in here. We just went to a conference. We just took all of them to Atlanta. One of our coaches had a conference there. Everyone came back all jazzed up, new scripts, new energy, like things to be bringing out there. I just took over a new listing from someone that, the agent just wasn't equipped. They don't know what they're doing. He's contingent on buying another house. I had to talk to that agent. She's like, I tried to help her out with this, like recommending a photographer, recommending a videographer. Like, she didn't have any of these tools. Sure. And then the seller's pissed off that his house isn't selling. I'm like, all right, well, I looked at every single house around yours, and it looks like they've all dropped between 9 and 10% before they sold from where they were listed. I was like, for you to be there, you need to be at this number. Yeah. And then he and I had a discussion again today. Never met him, never seen the house other than, it went on the market today. And we have a ton of showings already starting to be scheduled.
It'll be under contract by Friday.
Right. We have more aggressive marketing. There's just more information. And he's like, what's different with you guys? He's like, I didn't get to ask that. You were recommended by my uncle, whatever. It's like training, knowledge, experience.
It goes back to those vehicles, right? You have multiple vehicles to be able to get them to the finish line. Yeah. Multiple, being creative. You talked about contingencies, right? And people, before you couldn't have contingencies to submit an offer, but how many creative ways that we have to be able to make that work for you, to get you in the house, and then we can potentially sell it after the fact, but let's get you in. So that's where it is. It's key having, I can't stress it enough, right? The right partners to support you for, to make you achieve the goal that you want to achieve. Right.
There's always someone cheaper around there. You know what I mean? Like, you get what you pay for to an extent too. Some people like to chase that, and it's like, that's fine. Call us when you're ready, because you're going to be frustrated. You're not going to get where you want to go. And then inevitably we get a call later that it didn't work out. No shit.
It's the preparation, right? And I can't stress that enough for people. It's that if you're looking to buy a house, it is, whether you're buying a home, it's a test, it's a sporting event, the preparation that minimizes the risk, and the result's most likely going to be better, right? Other people, sometimes when you're just looking at the bottom line number and you're going, this is cheaper. Cheaper is not always best. What do I mean by that? Also, what's another example? Okay, you want a nice meal. The cheapest is to go to McDonald's, right? It's there, it's quick, it's easy. It's food. Is it good for you?
Maybe.
Right? Is it going to lead to other beneficial results within your life? Probably not. But
depression.
If you want, exactly.
Perfect.
Right? I don't know. Their hot mustard's pretty good, though.
It is good.
But the other factor is, when you want a good quality meal, you got to take the time to find the right restaurant, to make the reservation.
Pay the money.
Pay the money. It takes them time to prepare the meal. You got to be patient, right? You can go through each course, but it's an experience. And that's what we're trying to give, is the best experience possible. So
for us, same thing, just ultimate client experience. And then, talking about lending side, one of our agents, Brendan's got a deal, so settle this morning. Well, it's not now. And it's
was that last minute news with the lender?
Yeah, as of this morning. So there's a bunch of issues that could have been resolved potentially, or should have been known. And lender's unavailable, barely reachable, can't get a hold of all the people on that end that are involved. And all it is something that could have been mitigated maybe weeks ago had they just asked the right questions.
Or setting the precedent, right? So if you understand their situation from a detailed standpoint, right? When you understand their situation and you set a roadmap of the process of, here's where we are, this is where we need to go, and they fully understand, it's most of the time they just don't understand.
Right.
So you have to set that precedent up front.
Yeah.
So
comparing it to the 2008, I know you wanted to touch on some of that information. So what did you have for that?
So a lot of people are like, oh my God, is the market going to drop out? From a similar standpoint of 2008. Right. They're completely different markets.
Oh, right? Night and day.
And the only thing I think they have in common is the fact that
there's people involved, and they're not all involved,
and the market's, the market's dropped. That's it. Right. You can't compare then, because then regulation wise, from an entire industry standpoint, was completely different. Right. Also, when you look at the statistics, right, statistics of what was the average credit score then compared to now, they're much higher, caliber people that are now informed about where they need to be at.
Well, you said informed. I mean, just technology in general. Everything's at your fingertips.
Spread, yeah.
Right.
So you got credit scores. You got, from a savings standpoint, more people actually have reserves now than they did then, right? Okay. Equity standpoint, that's huge right now. A lot of people have equity in their homes. That wasn't the case before. You were significantly underwater, right?
Yep.
You
Interest-only loans.
Exactly. You're right. Interest-only loans, balloons that were due. So, when you have that, you have no leverage. Where do you have leverage now? You have leverage now in the equity. So if something really push comes to shove, you're able to pull that equity out.
Yep.
It may not be favorable loan terms for you, but you're not stuck. Right. So, those are some key components where they're not even remotely close.
Right.
And, I do I think we're going to go through a little speed bump? Yeah, we've been going through that, right? We've had COVID implications, and, markets and predictions are all forward going, right? So it's where are we at now and where are we going? How do we predict that from the future? But when everyone's like, oh my God, the market, it's going to be like 2008. It's not.
Well, they talk about, your net worth compared to a renter to a homeowner. It's roughly 46 times of a difference that renters, they have no equity. Yep. They have nothing. You're moving around, paying a shit ton of money for a house that you may or may not like with a landlord that you fucking hate, or maybe you like them. I don't know.
But I don't think I've ever come across a time where they're like, we love our landlord. We're going to stay here.
Yeah.
You know what I mean? That's not
the washer
the case.
works sometimes.
Yeah, sometimes,
nice.
right?
Or it floods or it doesn't. And maybe we get something, maybe we don't. Versus, you may have to pay for that repair on your own, but at least it's yours. You can have it done immediately. You can take care of it. There's options. There's warranties. There's whatever out there for you.
So that's just something I like to, to talk about, because everybody has this concern. And again, it's the tunnel vision that you hear on the news of everything that's negative, right?
Yeah.
And I think, again, as human beings, we're greedy. We're naturally greedy. So you hear interest rate at 2 or 3%, and then you hear 7, you're like, oh my God, now's not the right time to buy. But when you look at from a historic standpoint, right, in the 80s, rates were 18%, right? 20%. Then you go to the 90s, they were 10%. You go to the 2000s, they're around kind of what they are now. So we were just lucky to experience a time historically that was at an all-time low. But again, you're looking at one component. You got to look at the full picture.
Right.
And that is where I like to come in to provide that education. Yeah. And how are we going to make it feasible for you to buy now where it's actually beneficial, and how do we mitigate the risk right, of the higher payment?
That's all it is right now, is risk mitigation, creating certainty
right,
in an uncertain environment.
Yeah. So, big talk with the market is perfect timing. Fed just came out yesterday, right? Everybody's probably panicking.
Yeah.
Right. Rates, they just raised rates by 0.75%, which is a huge adjustment. So sometimes we'll go a whole year, right?
Yeah.
And they won't even adjust anything.
Sure.
Right. A normal adjustment's about 0.25%.
Right.
So 0.5%, double that, is a lot.
Yeah. Now
What's
you're tripling
massive
it.
is 0.75. Right. So people have this panic about it, but the main thing that they're trying to achieve is the inflation.
Yeah.
Right. And we're trying to get ahead of this inflation. I kind of call it the short-term sacrifice for the long-term gain.
Yeah.
Right. To get ahead. And the Federal Reserve, when they meet, their committee meets, they really have 2 goals, right? And the 2 goals are pricing stability and full employment, right? Those are the 2 things that they're focusing on. And a lot of the times when you hear that they're raising rates like this, everybody's in a panic.
Yeah.
That shouldn't be the case. It's hard to. I talk about how the market's forward going.
Yeah.
And I say that it's not always what they say, or it's not always what the Fed does. But it's what do they say, and reading in between the lines. That's the key component, right? And they raise the rates, people are going to panic, right? But what are they saying? And what they're saying is they came out because we like to see when they get off script.
Yeah.
Because normally they get up there, they're on script, they've got their stuff, this is what they say. But when they get off script, that's when you actually find out
the truth.
Exactly.
Right.
And what they're saying is that they're trying to get to a point which they're going to meet again in December to raise rates, to tell you how crazy it's been this year. They've raised rates. We're at, I think, about 3.5 or 3 3/4 the amount of adjustments.
Oh, wow.
So it's huge. Yeah. And I think it's historically, it's close to 1994 when they had that huge adjustment to be able to critique things. And where we currently are at is they're coming out in December, and what they said was, when they came out yesterday, was that they're raising rates, but they plan to stop at around 4.5. So what that tells me is the market's forward going, right? When it's forward going like that, we haven't seen the implications that these adjustments have made. Right. It's similar to our business. What we do in quarter one and what we do in quarter two is what we're closing in quarter three, quarter four, and then the market comes down and it's just snowballing from there. Here, we have a component where, they're drastically raising these rates. We haven't seen the change in how it's going to affect the economy yet. So that's the concern is, are we moving too fast? Yeah. Right. And, I think that now if I knew, granted, I wouldn't be sitting here with you. No offense. Yeah, no, we'd be drinking tequila, on a beach somewhere, or flying around with everyone else, with Musk, or maybe I'd be on McGregor's Lamborghini,
closing out Twitter,
something like that. But it's important to understand where they're trying to go, but also what are they saying? So these rates, they're raising them, but it's beneficial, and I think that we are getting ahead of this inflation for where we need to be at.
Good. Well, wrapping up, where can everyone find you on the interwebs?
So, guys, give me a call on my cell phone, 443-415-9170. I told you this before. I'm like an old soul in regards to text. Call me. Yep. You can Google me, find me on there. But, look forward to helping people and again, being a vehicle to get you into a home and achieve your goals.
Sounds good. Well, that's a wrap, everyone. Again, if you have any questions, give us a call, 410-638-9555.
It's a pleasure.